Dr. Red.
Dr. Brown, we are ready to proceed.
Okay. All right. Then it gives me pleasure to call to order the Facilities Finance and Audit Committee for February the 5th, 2021. I would love, and I want to give my appreciation to Ms. Gordon on yesterday for leading institutional advancement. They had a 1-hour committee meeting. I couldn't believe it. We started at 1 and we were adjourning a little before 2. So it would be nice if we could kind of stay in that vein. I know we have a lot more information to present, but I'm believing, looking at the agenda and the things that I've already had an opportunity to look at, that this is going to be an outstanding committee meeting. I think everybody's going to be pleased with the reports that are going to be coming forward. So I'm excited to move forward with this committee today. So with that, Dr. Red, can you give us a roll call, please?
Yes, ma'am. Good morning. Dr. Valerie Brown.
Here.
Mr. Michael Fleming. Excuse me, Mr. Raul Herrera.
Here.
Thank you. Mr. Charlie Hill. Mr. William Murray.
Here.
Mr. James Deadmeyer.
Here.
Mr. Wayne Turnage. Mr. Gregory Worley.
Here.
Mr. Huron Winstead, our rector and ex officio member.
Here.
Madam Chair, Mr. Hill did not answer, but I know he is here.
Yes. Okay. Thank you, Dr.
Thank you.
Thank you. We'll now have invocation by Rodney Hall.
Good morning. Let us pray. O Holy One, who walks in presence among us, we thank you for being a refuge and strength, a pleasant help in troubling times. As we gather today, celebrate the opportunity to continue our mission, meet our academic, social, and psychological needs. We ask that you would give us wisdom, you say and do. Amen.
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 And I would ask, if you're not currently speaking, to everyone to please mute. Yeah, so we can eliminate any background noises. We appreciate that. Once you are preparing to speak, you may unmute. I need a motion right now to accept the agenda. You should have had it on your diligent along with other documents. If there are no changes or questions on the agenda, I'm ready to accept a motion to approve the agenda.
This is Bill Murray, and I so move.
Can I get a second?
This is Jay. I'll second.
All right, we have a motion to approve the agenda with a second. Dr. Red, may I have a roll call, please?
Yes, ma'am. Dr. Valerie Brown.
Yes.
Fleming. Mr. Herrera. Mr. Hill.
Yes.
Mr. Stegmeyer.
Yes.
Mr. Turnage. Mr. Worley.
Yes.
Mr. Murray, did I skip your name?
Yes, ma'am. Having made the motion, yes.
Thank you.
Okay, thank you, Dr. Red. You also had on your diligent board the minutes from our previous meeting. Hopefully everyone has had an opportunity to also review those. Are there any questions or changes to those minutes? If not, I will accept a motion and a second to approve the previous minutes.
This is Bill Murray, so moved.
This is Jay. I'll second.
Okay, we've got a proper motion and a second to approve the minutes from our previous meeting. Dr. Red, once again, may we have a roll call, please?
Dr. Brown,
Yes.
Mr. Fleming, Mr. Herrera,
Yes.
Mr. Hill, Mr. Murray,
Yes.
Mr. Stegmeyer,
Yes.
Attorney, Mr. Worley.
Yes.
Thank you.
Thank you, Dr. Red. Good
Madam
morning.
Chair.
Yes.
Yes, if I could, I'd just like to express the appreciation for the quality of the minutes this time. I really appreciate having the complete record of the committee's meeting to go back and look at and verify the actions from the previous meeting. So wanted to let staff know that I appreciate that.
Very good, Jay. So do I. It was very good. Thank you for that. I'm sure they appreciate that too. I'm sure most staff say they don't get the good comments quite as often as they get the constructive criticism. So thanks, Jay. Appreciate that. They're doing an awesome job. And with that, President Abdullah, you are next on our agenda. Welcome and good morning to you.
Thank you very much, Madam Chair, and welcome to all of the board members. We appreciate having you, of course, all the time on campus. Thank you for welcoming us into your homes today. I would just like to say briefly that we are very excited about where we are. I think a lot of emphasis in the past couple of days has really been on revenue generation because we've had a lot of that over the past couple of months. But I wouldn't want that to take away from the fact that one of the great successes over the past couple of months has really been fiscal management and the work that Mr. Davenport has done. And I think that in the reports, I think you can get a chance to see where we are and how close it was to our initial predictions and how we're kind of outperforming where we expect it to be, even without the additional revenue that's coming up. So I wanted to make sure I gave him and his staff those kudos. And with that, thank you very much, ma'am.
Thank you, President Abdullah. Mr. Davenport, you are up.
All right. Thank you, Madam Chair. I want to start the agenda today. We have some guests, investment managers. I think you all are aware we actually have two investment managers, and today I'm going to start. They're going to talk a little bit about their market conditions and allocations and performance, and just kind of summarize the results for this year and talk a little bit and kind of answer some of the questions that you have. We're going to start, and I'm going to ask their representatives first from Spider Management to come forward, and they can introduce themselves.
Well, Kevin's hopefully getting our presentation up. I'm happy to be here, albeit virtually with some of you and behind plexiglass for the rest of you. I guess this is sort of the transition to a somewhat new normal nowadays, but we're happy to be here. And my name is Tori Spray. I'm the Director of Investor Relations here at Spider. For those of you who I don't know, although I've been here for many years, so I recognize many of you, but I've got two new members of our team here, which before we get into the presentation, just wanted to introduce them. The first is Will McLean. He's our new President and Chief Investment Officer, and I'm gonna let him actually speak for most of our presentation to talk about recent performance, but also where he sees the portfolio going forward. But we're really excited to have Will join. Many of you may remember that we announced a succession plan in the fall of 2019 when our previous president and CIO was in the process of stepping down. And so our board started an external and internal search for our new president and CIO, and Will sort of ended up being the perfect combination of both, as he's previously the CIO at Northwestern University's $11 billion endowment, but he's served on our board and our investment committee for many years. So he's very familiar with our portfolio. He knows especially our senior team really well. So while he just started in January, he's really hit the ground running and knows us and our portfolio well. So he'll talk about what he's doing in the portfolio and why he joined Spider. But before that, I also want to introduce quickly Dejan Johnson, who joined my team in investor relations this summer. So he'll be part of my team to answer any questions, particularly the staff may have, or as you're looking to add or withdraw assets or any questions on the portfolio. So I'm going to let Dejan introduce himself quickly, and then we can jump into our portfolio.
Well, thank you for having me, everyone. Good morning again. My name is Dejan Johnson. I'm the newest team member in our IR department. I've been here for about 7 months. Prior to this, I worked in client relations at Vanguard. And in previous internship experiences at Johnson & Johnson and Cantor Fitzgerald, and I'm at Hampton Graduate University, which might not be the the most favorite thing in the room, but thank you for having me.
Okay, thanks. Kevin, can you?
Welcome, Dejan.
Why?
We'll excuse you this time, Dejan.
I know, I was scared to have Dejan mention his background too much, but. No. Anyway, so if we start in our presentation on page 2, this is your market value summary, which I'll just note that right now, everything in this presentation almost is as of September 30th. Our team is in the process of finalizing our valuations for year end, just the nature of the types of managers that they report a little bit later than if we were in more of a traditional kind of stock bond portfolio. So we'll get those preliminary December numbers out in just a couple weeks. So right now we've got September, but we're going to do our best to give you all the estimates we have for December. So you can see your September balance is about $21 million, and we'll get more into performance, but it looks like it's going to be a really good quarter for us for the fourth quarter. So I expect as of December that your balance will be closer to about $23 million once we get those numbers finalized. And one thing quickly that I'll just note on our reporting, because I know there's been some questions in the past, is particularly on the private side, our private equity venture capital managers, they report more like 45 to 60 days after quarter end. So the timing of our reports is really just a function of when we're getting those reports from our managers. But as Will is going to talk about recent performance, private equity, particularly venture capital, has been a huge driver of recent returns, both historically and recently. And so while there is a bit of a trade-off with the timing of reporting, we think it's worth it in terms of the quality of returns we're getting. And just one other note on your balance is, I know you guys were lucky enough to get this amazing gift recently, and so it's good timing because as Will's joined the team, he's really looking at the liquidity and the investment opportunities for our portfolio, and he can talk in more detail about that. But we were closed for a number of years after we accepted some new partners in 2016, but as we're really looking at the investment opportunities and some of the new manager relationships that Will's bringing from connections at Northwestern, he sees an opportunity to grow our client base a little bit. And so our goal is always to first grow with our current partners, and so that would be fabulous if we could continue to grow with VSU, but we may down the line be looking at adding a few partners who share our same investment philosophy and long-term beliefs. But one thing to note, just as you're thinking about adding new capital and the existing capital you have with us, is we recently, as of January 1st, have lowered our management fees for the first $100 million of assets. So it was previously 75 basis points, and now it's 60. And so that was just, we did a market study and saw that there was really an opportunity, particularly for managers like us, invest in more alternatives, but that gets us more in line with where the market's been. So we want to always be delivering great value to you all. So that's going to have a great impact on net returns and the value you see going forward. So happy to answer any questions that you may have on that, but I'm going to, in the interest of time, let Will take over and talk about performance and his plans for the portfolio going forward.
Thanks, Tori. It's good to be with you all and be on your campus for the first time. I was reminded that Virginia State was really the first client Spider had, even before Spider was formally launched. The university partnered with Virginia State to managed fund. So it's a very important relationship to me and to all of us because, you know, all our partners are important, but you're our first, so there's something special about it. I came here, January 1st was my first day, but as Tori said, I do feel like I know the portfolio very well. I've spent 38 years in nonprofit investment management, the Duke Endowment in Charlotte, North Carolina, the MacArthur Foundation in Chicago, and Northwestern University in Chicago. So over that time span, one of the pleasures I've had in my investment career is to work with smaller institutions, serving on boards and investment committees. It's in my bio, you can check it out. But it's really a part of what led me to leave Northwestern and come here to lead SPDR. So it's a perfect setup for me because I believe in the university, I believe in the mission, I believe the access to the great managers that SPDR has already gotten, and so we're off and running. So let's talk about the market. I think most of you know that 2020, slide 3, was a roller coaster year, huge downturn in the early first quarter. Portfolio held up okay, but took a hit somewhat. All portfolios did, and then a huge bounce back in the second half. And who would have thought that the market would have been up 20% in the year? I would say for us, we've benefited quite a bit from our venture capital portfolio is 15% of the overall endowment. And if you see on slide 4, these are the biggest IPOs since the last 2 decades, really. And you'll see that 3 of them were in 2020. Most of you are aware of Airbnb. We have some Snowflake, which was a huge success for the university, and you're beneficiaries of those IPOs. And there are more to come this coming year, primarily through managers like Founders Fund, Tiger Global, and Hill House in China. Any questions about the IPO market or venture capital? If not, we'll jump right in. Performance and asset allocation. As you can see here, there's a history of our asset allocation, and it's a big part of our portfolio, as you can tell from the pie chart, is in alternatives, 35 to 40%. We have 22% in private equity of September 30th. That number is even higher today because of the market appreciation. But I would point out one of the things that our board has really been emphasizing and pushing over the last 4 or 5 years, and you'll see the first column, long only. These are stocks that are actively managed, private equity. Those are the pieces of the market that have been growing. Some of it because performance has been good, but some of it's from intentional. That's where we've seen opportunities. That's where we see bottoms-up chances to invest with great managers around the world. So if you go to our next slide, just quickly on performance, these are at September 30th numbers, as Tori said, and you'll see that this quarter just ended extremely strong. And a lot of managers had strong numbers in the third quarter. We had outsized alpha too because the market value jumped above what the 70-30 mix did. We also had the same sort of thing for the fourth quarter. The fourth quarter is going to be equally good. I don't have the final numbers. We're coming up with estimates. You should receive them soon. I'll show you some details on the fourth quarter in just a second. Okay? So if we think about access to managers, concentrating our bets, here's what our main offering is. You have access to these types of managers. A lot of these managers are closed, capacity constrained managers, and we have 36% of your money in these top 10. We're concentrating our bets with some of the names: London-based, China-based, Founders Fund, Silicon Valley, Tiger in New York. These are managers that we're proud to share our returns. And I think, as you know, the beauty of the SPDR model is total alignment with the University of Richmond. Whatever the University of Richmond gets, Virginia State gets. Equal returns. So if you look also at the next slide, you'll see that a lot of these top 10 managers have driven performance over the past year, and they continue to in the fourth quarter. So the bold managers were top 10 managers in the contributors. And I think you can look over on the right and you see some of the eye-popping numbers that they delivered, proving out the worth of active management and having managers that are truly world-class. I'm not going to skip over the detractors either. you'll see what hurt the portfolio. In large part, it's some of our real assets managers. Energy, as you're aware, had a rough period because of the price of oil. It was probably the only part of the portfolio that underperformed substantially, and it's something we're spending a lot of time thinking about. The good news, most of you know that the energy prices have stabilized. Oil's $52, $53 a barrel, and a lot of those names started recovering a little bit in the third and fourth quarter. So moving on, fourth quarter, again, each month, these are 65% of our managers that we do have numbers from through December. And in each month of the fourth quarter, by the blue bars on the right, you see we outperformed a 70-30 mix. And these managers were up over 13% in the fourth quarter. You'll be receiving this report in the next 2 weeks. Digging a little deeper, you received, Kevin and his team received this last week. This is a new report that we're trying. I think one of the things we really want to stress is reporting and transparency is going to increase even further. And you'll see with the drivers in the portfolio for the past year, the long-only portfolio, you'll see long-short stock pickers. These are hedge funds. There's 4 of them. They had a tremendous year last year. The credit managers, multi-strat, not quite as good, always transparent about what's not working. But in total, this was as good a quarter as Spider's ever had. So we've had back-to-back quarters that were better than Spider has ever done in the past. And I just showed up January 1st, so I get absolutely no credit for it, and I'm not taking any credit for it. So you should thank Rob and the current team. Let me pause there and see if there are questions on performance.
Yes, I have a question.
Please.
This is Valerie Brown. On the previous slide, if you can go back to slide 10, those are the returns that Spider as a company earned. I see double digits. I'm looking at quarter to date and also the 2020 returns. And yet on the Virginia State, if I'm understanding your PowerPoints correctly, less than double digits. We're at 6 and 7. Am I reading your slides correctly? And if that is the case, why were we not in double digits? I'm on other boards and even personally for 2020, just like the slide you showed with the significant increase in 2020, I would have thought that our returns would have been in the double digits.
I think maybe you're referring to the chart, the previous chart that had the 930 numbers where you were showing 7.9 for 1 year. Is that what you're referring to, Dr. Brown?
Yes. Yes.
Yeah, and that is through September 30th. And
okay.
What I'm talking about on this slide 10 is December estimates. And okay. I don't want to get it, but I can promise you for December 2020, with the year end, the 12 months ended 12/31/2020, you will be double digits.
Okay.
And I don't really know what the number will be, but
Yeah, so
13 to 15 is
the estimate for the quarter was 8% for September, and so we're anticipating probably something 8%, maybe a little north for the fourth quarter. So add that on to the total 1 year, so it'll be in the double digits once we get those December numbers out as well.
So I'm glad you pointed that out because it's always confusing when you have September numbers that are fully baked with all the private equity reported, and then December becomes a partial until we get these quarterly numbers, which will probably take place in the next month.
Okay. Yeah, I just would have expected. I mean, most portfolios are doing double digits and doing extremely well in 2020 despite COVID. And so I just would have expected this to really be a banner year for our performance.
You're absolutely right. And I think most people, you will see, like, for example, I think a 70-30 portfolio is going to be up 13 or 14%. For the year. So you're absolutely right.
Thank you.
Other questions? Okay. The final slide I had was just to talk about themes in the portfolio. We've spent a lot of time since I've been here working on some manager relationships, bringing some new ones that I've had from Northwestern and over the years. We're pleased with the progress there. We've also been doing a major asset allocation study, which you'll get a copy of probably after the Richmond board approves it. You'll be able to have a copy, and we'll share it with you, and love your feedback on it. And that's a big thing that's going on. The third thing is transparency and reporting. As I said, Kevin's going to start noticing, and your investment committee and whoever wants to see these things is going to notice, more transparency around the actual portfolios, and that's the right thing to do, and we're happy to do it. I think the final thing I'd say is we're spending a lot of time getting to know our clients. I'm spending time with folks. Dr. Ron Crutcher, some of you know Dr. Crutcher. He's also he's on our Spider Board of Managers, and he is sending out letters to his friends in the university world, independent colleges, and because he really believes strongly in this partnership, you'll be hearing from Dr. Crutcher as well. But I'm really excited to be here. I will stop, and I really feel like this is your meeting, but please ask questions. I want to be respectful. There's another group behind us, but I think our 15 to 20 minutes is about up. But Kevin, anybody else have questions? We're delighted to answer them.
I have one more. I'm sorry. This is my left brain. My left brain working really hard this morning. If our portfolio conservatively invested, and by your standard, because again, even at 13%, I'm not happy. It's double digits, but I personally, I'm not happy. And on other boards, I'm not happy with that number for 2020. So is it because we are conservatively invested? Is it a state mandate that we be, maybe our balance in terms of how we invested is more on the conservative side? I'm not sure if it's state mandated or if we have mandated it. And would you consider us to be conservatively invested, considering other nonprofits and things who've done even higher than 13% for 2020?
It's a good question. If you go back to the asset allocation slide, we'll pull up the asset allocation. And to be honest, I think you're on the key point. When somebody had returns of double digits, where did it come from? And last year, and you're absolutely right. And I think index funds certainly did well. You could have invested just in the S&P 500, and you would have done very well. Why mess with all these fancy strategies and private equity and venture capital? And I think if you look at our portfolio, I wouldn't say that you'll see 30% in long only. You'll see 23% in private equity. Those categories they're both going to deliver market plus. Long, short, you can look at last year and see what those outperformed long only by quite a bit. Then you look below it, and you're going to see some things that are a ballast to the portfolio to offset some of the equity risk. Some of those things are in our multi-strategy portfolio. Credit, we try to hold some cash. And then finally, things like real estate and real assets that diversify inflation. So the risk level on this portfolio, I would argue, is 70%, roughly 70% at least. And we want to have some things that offset. The equity markets aren't going to go up every year. We want to make sure we have a balanced portfolio. And obviously, years like this, where the markets are straight up, assets that mark only periodically, meaning quarterly. It takes a while. Some of these things that you're invested in are growing internally. In other words, these are private companies that they're not getting marked up to the extent the market is. So we're highly confident that there are a number of things in the private equity portfolio that are undermarked at the present time, but time will tell. So I think the risk is appropriate in here now, and we're not going to shy away from making sure we have to have things that offset the equity risk. We have to have things that give us liquidity, because we do have a number of things in here that are illiquid, and so we have to have something to offset it. But I appreciate your asking the question in that way, because it is the right question. That's why we're working on this asset allocation. What's the mix of asset classes that you want to have going forward? And ironically, when you have a year like you have, and we're doing some of this, our bias right now is to take a little bit of risk off because we're over in our targets in some of them. So hope that answered your question.
I'll chime in also, is you're right that we are, we're not trying to keep up with a 70-30, a S&P 500, especially when it's gone, had such a crazy rebound and goes straight up like that. We're really trying to, since we invest all the assets of nonprofits who have quarterly spending needs, we're trying to have lower volatility and protect on the downside. So in the first quarter, when you saw markets crashing, we were down about 10.5%, as opposed to the S&P, which was down in the 20s, and 70-30 was down about 14%. So we're really looking at that. And so if we don't think that this, huge equity bull market is going to continue forever, and for protecting the assets of nonprofits who need to meet spending, we're trying to have lower risk and not have as much volatility. So you're right that if you're looking at other portfolios that maybe have a bit more of a bias towards, public stocks that we have underperformed, but it's when on the downside that really makes a difference too.
So is our portfolio actively managed? In other words, once you make our investments, are they sitting there for the year? Or do we have a lot of activity where we're trading back and forth? Because again, when the market took an upturn, there were a lot of portfolio managers who sold out and shifted to capture those quick gains. And then, of course, obviously sell back out, taking those gains with them. Or do we have a strategy that once you've invested, they just kind of sit for the year? What's the turnover in our portfolio?
I think this year in particular was another example of Spider is opportunistic and tactical, and invested quite a bit of money in the March, April downturn in credit strategies and some public equity strategies. So yes, the answer is, and I would turn you back to slide 8, and you can see. Yeah. You can
133%. I'm just saying, even personally, my portfolio personally doubled. I have other boards I'm on. 2020 was just a banner year. And if it was actively managed, I just would have thought we would have even been in at least 20 and 30% returns, as opposed to whatever our investment were at the beginning of the year, letting it stay there and not taking advantage of the market going up and down.
No, I think, as you can see on the slide 8, we did add to a number of strategies during the year, most around April and May. You had to hit it fairly quickly. You couldn't sit around. The S&P, I think, was up about 19 or 20% last year. And again, that was the largest gain other than China. China was up more. We have 12% of our fund in China, with primarily Hill House and Himalaya. You can see their returns on slide 10, I believe. Tori, would you hit? And you can see that there are plenty of managers that took full advantage of it. So our China managers, some of our long short, but happy to dig into the individual ones. But no, we're not. I don't think you're with a portfolio like ours where you're investing things in strategies that are long term. In other words, we make commitments to managers for 5, 10 years. These are private equity guys or venture capital girls, and it's a commitment that's a long-term commitment. But there are parts of the portfolio where we have access to liquidity, where we will press the bet, if you will. And you're exactly right. March was the time to do it, when you get a sell-off of that magnitude. But it is interesting. I know you're in the markets and you're remembering it, but at the time it wasn't easy to do it, right? It didn't feel real comfortable, did it? But I give Spider a lot of credit for putting money to work then.
Thank you.
Thank you. Madam Chair.
Yes.
Thank you. I think this was having sat through this a couple of years, it seems like that's always the dilemma of how much importance do we as a board put on stability versus risk. And I think those are really good questions. Kind of also coming at it from that context, though, I see where we were on September 30th, and I understand your strategy and your confidence in the private management money. And this was a year where it was good not to be overinvested in real estate. But I'm wondering, with where the market is today and where the prices are, what are you anticipating, and do you expect to make adjustments in the coming year? And you did mention you were looking at reallocations, but specifically I'm wondering about how you're interpreting potential inflation pressures and sectors like real estate. Are you looking at, staying conservative on real estate, or are you looking at possibly seeing real estate or something else as a potential inflation hedge, or what are your thoughts on that?
Well, thanks for that question. You had a lot of good points in there that I think on the inflation hedging. The big question right now is when you think about a portfolio, the risk to where interest rates are. You think about a portfolio like ours, you notice that there's not really any fixed income in there, because at these level of interest rates, you're not being compensated for any type of return. So where do you balance your portfolio? Where do you put your money to work? And real estate happens to be another asset class that in general has benefited from interest rates dropping over the last 15 or 20 years. So cap rates in real estate are, as you know, very low. Our real estate approach has been to try to align ourselves with managers who have expertise in specific niches, such as apartments, selected in the office, industrial, where but their returns are coming down too. They're expecting 8 or 9%. They're, net. And that is a more steady 8 or 9% than, say, you can take more of a commodity bet in energy. You'll see our energy investments are lower. They're about 5% of the whole portfolio. And that's obviously an area where you've got to really be careful, because the price reflects a lot of damage to that sector. And the portfolios in there, but you also have an asset class and a category that is under pressure. And fossil fuel investments are, how fast is that going to disappear for renewables? And those are the kind of questions you need to, to question. I'm happy to follow up more on the real estate in particular, but I think we're so conditioned to low inflation, and we do think inflation's going to be low. I think you still have to have an eye on where inflation could come from, whether it's labor inflation, whether it's commodity inflation, and you need some exposure to it, again, to balance the portfolio. I think managing rearview mirror on what's worked totally, which is the hot. Obviously, technology has been a big driver of our portfolio and others, but they'll have. We still believe in it, but they'll have their day too. So we're big believers in having some balance to the portfolio. And back to your very original point, if you ask us, the asset allocation study is going to show that expected returns for the next decade are going to be lower. If you look at any third-party estimate of what expected returns from markets and market securities are, they're all lower than they have been. And back to slide 6, I'll just make one final point on the risk. And you can see here that the SPDR portfolio, the volatility, as Tori mentioned, less drops in the crises. That has a big difference. If you don't fall as far, it has a big impact on your overall returns. So the Sharpe ratio has been a strong one ever since you've been with us. Next, more questions?
Madam Chair?
Yes.
Yes, a couple questions about the makeup of your firm. What is the diversity or staffing of your organization, and how large is it?
Sure. We have 18 professionals at SPDR, and they have a lot of experience. They're CFAs. They're probably half women, half men. There's not a great deal of diversity in terms of the makeup of the staff. The thing I would say about diversity, we did a lot of work on this at Northwestern and talking to our managers, is you can talk all you want to about hiring diverse managers, but if you look at your own team and your own team doesn't reflect it, then you really don't have any credibility. So the onus is on us to increase the diversity over the next 5 years, and you'll see it. So I don't say it's something that we're working on. Let's put it that way. Happy to follow up with questions on that. Dejan and Tori just sent out a survey to all of our managers, something we did at Northwestern. We want to understand the diversity situation of all of our managers, ownership, partnership. We've developed a list of managers that I brought from Northwestern that are diverse manager candidates. We used to do this at Northwestern where whenever we would visit a city to see money managers that we already employed, we would make sure we sought out women-owned, minority-owned firms. So we would build a database of the best upcoming managers. Happy to answer further questions about, diversity initiatives. And also hear back from you on that.
We'd love to have some summer interns from Virginia State. That would help introduce those folks to the county business. Secondly, and are there any black-owned firms you're invested with?
We do have some. It's a tricky thing with Ariel. John Rogers is a friend, and John has done more, as you know, from Chicago, has done more for the business of minority-owned managers, and that's an effort that he has made. We just met with a consultant in the business who is going to help us as we think about how we reach out, how we expand our minority manager database, as well as the hiring. And so I can assure you, you'll see progress on that front too. I mean, I think one of the tricky things, as you know, is there's always, it's okay and it's not bad to check the box and say, oh, we're going to hire a minority-owned large firm. But where I see the issue is, how do we support the managers that are up and coming, who don't yet have a track record, who have talent? They're harder to find, but they're out there. And those are the places, that I'm just talking me personally, that I believe that we should support. And that's where you're going to see, you'll see some things pop up there, because I think it's the right thing to do. I think those people there's some incredibly talented women-owned, minority-owned firms, 1-2-person shops that are starting a track record. And they're only going to get there if somebody gives them some money. So that's perfect.
Yeah, that's my concern, that if they don't get any money, they can't grow. And many times they're too small for people to invest with them because their portfolio is not that large yet. So I appreciate whatever you're doing in that regard. Thank you.
You're welcome.
Any other questions?
Madam Chair,
Yes, who is this?
this is Raul Herrera,
Yes, right.
and I would just like to echo the questions asked by visitor Sessions in regards to the makeup of the advisor, its diversity, and working with other diverse money managers and the like. And we'd like to have that reported on in future meetings, just to see the development in that regard. Thank you very much.
Absolutely, and I appreciate you saying that. And I would also, whoever suggested it about the internship, have the person that works with you on that send Tori a note.
We'll get it done. Thank you, sir.
Mm-hmm. That's easy.
Are there any
look, I want to finally say, I mean, that's the whole beauty of what we're talking about here, is we're 30 miles away. We're in the neighborhood. We should be, we believe we're part of your mission. And that means more than just running your money for you and trying to make more money for you. That means trying to help if you've got issues. We're actually, one of our partners is asking us to look at cash management or an index fund product or a more liquid fund product. Those are things that we're investigating as well, because we really, unlike a lot of firms, we're not out really, we're looking to grow with our partners. we want to have we think $5 billion where we are now is a great size to invest. Maybe 6 as we all grow. So we can take a little more money, but we're not looking to grow. We're looking to be with the partners we have that want to be with us and develop that kind of relationship. And I think that's the selling point here. And I think that's from what I'm hearing from you is let's keep working on that partnership part of it too.
Any other final questions? If not, thank you very much.
Thanks for your good questions. Take care.
Thank you. Thank you. Kevin, are you back up? Yes. Okay.
Yes, I'm back up. I was gonna have the representatives from Greystone come up and give their report now.
Thank you.
Our second manager. Thank you.
So good morning. I'm Craig Dunbar, and my partner Chip Brockmeyer. We're with Greystone Consulting, which is a business unit of Morgan Stanley. And we have been working with Virginia State University on this portfolio. We'll be celebrating 5 years on February 9th. So proud to be here and proud to be part of this institution and managing this portfolio. I'll turn it over to Chip in just a minute. Again, I've been with our organization 20 years, founding partner of our practice. Chip and I manage the institutional side of our practice. He's been the lead on this relationship since the passing of one of our senior partners, Ken Cox, just over a year ago. So again, happy to be with you this morning. Chip, I'll just turn it back to you for a second.
Thank you, Craig, and thank you, committee. I just wanted to start out just talking about the relationship that Morgan Stanley has with VSU, specifically our local office of Morgan Stanley. Our Southern Virginia Complex Director, Hugh Steiner, has been a guest instructor at various classes held at VSU, and again, this is all coordinated through Jonathan Young. Morgan Stanley has taken VSU students to the Richmond Ballet, which Morgan Stanley is a sponsor of. And Hugh has also served on various industry councils held here at VSU. Back in 2016, Morgan Stanley hired Amina Magaji, VSU graduate, and Amina has worked in New York City. She was our NBA content coordinator, and that has nothing to do with basketball. It stands for Next Best Action, and it's a high-tech, high-touch contact tool that Morgan Stanley financial advisors can use to communicate ideas, best ideas, with their clients. Now, Amina is in California and is a consulting group advisory director at Morgan Stanley. We also hired, Kiri, a student here at VSU a couple of years ago, went through our local Morgan Stanley intern program as well. Some current initiatives that Morgan Stanley has, we are sponsoring 4 VSU students this semester to take an online course entitled Best Business of Entertainment. That's done through Columbia Business School. This is an online course, but Morgan Stanley is sponsoring 4 VSU students to do this. Stephanie Churchill and Morgan Franklin in our local office in Richmond are holding a diversity and inclusion panel discussion later this month here at VSU. It's a virtual online discussion. And then later this semester, a mentorship program is going to start where 5 local Morgan Stanley employees will mentor 5 VSU students, help them with resume writing, interview guidelines, and just provide them with a contact in the business world to encourage them in their career choices going forward. So this relationship, as Craig mentioned, has been spawned over the years. It continues to grow, and we view ourselves as a partner with VSU in the community here. So with that, I'm going to briefly go into our economic outlook, and let me just And I'm not going to go through each of these slides, but let me just give you some comments, summary comments about 2020 and our outlook for 2021. So 2020, we know with the sharp downturn in March, markets recovered. S&P closed up over 18%. International was up 8%, and the Barclays Ag, which is a bond index, was up 7.5%. We are bullish on 2021 for several reasons. Typically, bull markets begin when a recession starts, believe it or not, and that's what happened in March of last year. Since then, markets have gone up, the economy has started to open up, and these bull markets typically last years, not just months. The fiscal and monetary stimulus provided by Congress and the Federal Reserve have really been unprecedented. You have to go back to World War II to find a comparable period when there was so much stimulus going into the economy, roughly about 25% of GDP. You know, Congress has, it looks like, is on the cusp of approving more stimulus money even as we speak. So that bodes well for the markets and the economy in 2021. Economic data is turning up. You know, we had a massive contraction in GDP, but then we had a massive recovery as well. In the fourth quarter of 2020, GDP grew at 4% annualized rate. For 2021, we feel GDP will grow at a 7% annualized rate. We recently just upped our forecast. And the operating leverage that companies have, you know, they've cut costs, they've cut, in some cases, employees. As the economy opens up, that leverage they have, it's going to flow through to their bottom line, and their profits should be up tremendously in 2021. Now, there are some sectors of the economy that are obviously going to be slower to come back than others. You know, restaurants, retail, travel, they're going to continue to have some challenges. But with the vaccine, you know, coming out and more vaccines, different ones being approved, the economy should open up tremendously here in 2021. In 2021, we probably will see a shift at some point from the growth stocks, the stay-at-home stocks, if you will, that did so well in 2020, you know, names up 30, 40%. We're probably going to see a shift away from those names into the recovery names, financials, industrials, material type stocks, more of the value type stocks as opposed to growth. Growth has outperformed value for years, but we feel value has a shot at doing much better as the economy reopens here in 2021. In terms of our base case for where we feel the S&P is going, it's basically already at our base case that we forecast several months ago. But our bull case has the S&P going to 4,200, which is about 8% higher than where we are right now. So again, it's a good positive outlook for stocks. We may see a correction along the way. We typically do see corrections each year of around 10% at some point. In the past, you know, going back to November, the market has just continued to go up, and pullbacks have been few and far between. They've only lasted a couple of days. So, you know, there may be some fits and starts along the way, but overall we are bullish on the stock market, we're bullish on the economy, and you know, think it's a good time to put long-term money to work. With that, I'll turn it over to my colleague Craig to look at the specific performance of the VSU portfolio.
Thank you, Chip. So in our role as your consultant, working with Kevin and the Finance Committee, we established initially a written investment policy. It gives us the guidelines for allocation, risk tolerance. That's a policy we review at least on an annual basis. The second step of that is once asset allocation and target returns are established, we do the asset allocation study work. We also update that on an annual basis to make sure our expected returns looking forward are going to meet the expectations of policy and of this committee. We then hire and select managers in each of those sleeves of the allocation. And the allocation consists of U.S. equities, international equities, fixed income, and alternatives. All of our managers are liquid, meaning valuations are priced daily, thus allowing us to provide performance reporting that can be updated really as a day-to-day basis. So what we're reflecting on the first page here, called Asset Allocation Analysis, there's a column called Strategic Allocation. That is the policy allocation. It consists of 36% U.S. equities or domestic equities, 23% international equities, 20% fixed income, and then 21% to alternatives. So we're looking at basically a 60-40 blend. Again, our alternative investments, to compare and contrast to SPDR, our investments are going to be liquid and marketable. Neither con, it's just a contrast and difference. So I would describe the target as a balanced approach. We do have some sectors that did quite well last year, certainly U.S. equities on the growth side. But it's our responsibility to monitor the policy allocation continually to make sure we're within compliance. And you can see under total fund, this is the VSU portfolio. So our target is 36. We're currently at 36.7. The target to international is 23. We're at 23.7. We're slightly underweight fixed income and alternatives, and that's really just due to the growth in the equity side of the equation. Can we go to the next page? So here's a list of the total funds, and all of this data is through the end of the year, the calendar year, December 31st. And on the left-hand side, about halfway down, you'll see the Virginia State University portfolio returns in bold, and then you'll see the policy benchmark listed below that. Virginia State University returns on the quarter, up 10.73%. Calendar year to date, that would be fiscal year 2020, calendar year 2020 up 11.99, and the fiscal calendar for VSU, so the 6-month period since June 30th, up 17.69%. And again, my opening comments, we've been on board here as your consultants back to February of 2016. We've compounded at 10.56% versus the policy benchmark of 9.65. And how does that translate into dollars? Since inception, we've got started with $8,556,000. We've had net contributions of $6,112,000, gains of $8,626,000, with the ending balance of just over $23 million. And through last night's close, we added another 2% on the calendar year to date. So again, back to Chip's comment, markets continue to expand, and this portfolio continues to participate in that. The next couple pages drill down into how each of the underlying managers participated. I'm not going to go line by line. This is information we review at the committee level, but you can see some of the higher returns on the calendar and fiscal year to date. are going to be your U.S. equity growth managers, T. Rowe Price, and the iShares, for example. Calendar year last year up 37 and 35%. Fiscal year up to date anywhere from 21 to 25%. So certainly the growth sectors have performed. Value stocks have lagged. MFS value up only 3% on the year, but versus their benchmark of 2.8%. So again, they're fishing in a slightly different pond. We do believe the value stocks will come back into favor. We scroll down a little bit further. We look at some of the smaller and mid-cap managers, which again also contributed. Fiscal year to date, and they're still in the 20s and 30s. And then if we look at international, nice returns, 22 and 26%, still not what U.S. has delivered, but we do think there's continues to be opportunities within international. And then on the fixed income side, where we have a 20% exposure, we're getting 2, 3, 4% type returns on the traditional fixed income and 11% in our high yield managers. And then the last category is alternatives. Again, these are liquid alternatives. Guggenheim Macro Ops up 12% fiscal year to date, 11.5% last year. And again, the reason we have fixed income, the reason we have alternatives is that we need to take a balanced approach. That was the committee's choice with our influence, certainly at inception, and we continue to review that at least on an annual basis. We collaborate with Kevin and that committee on allocation and manager selections and changes. But I'll pause there for any questions that we might have about the portfolio or about the markets in general.
Any questions? Okay, if not, thank you very much.
Thank you.
Just briefly, I think, Kevin, did you want us to address what we had discussed about an addition? Okay, sure. So just wanted again to congratulate VSU on the bequest that you got at the end of the year. Congratulations on that. And Kevin just wanted to briefly chat about, how you could get that invested. We talked about dollar cost averaging whatever you don't need, in the next year or two. Don't put that in your long-term portfolio. If you need funds next couple of years, set that aside in something liquid that you can tap, and you're not concerned about the market fluctuating with that. But your longer term money, you could invest that by dollar cost averaging and, see that 25% a month, 10% a month, whatever the percentage is. And that way you've got a plan of putting it into the market a little bit each month. Hopefully we'll get a little bit of a pullback where you can invest it at a cheaper price. But we don't know when that's going to happen. I mean, it could happen in a couple of months. It may take, a year or more before we have a significant pullback. But by dollar cost averaging in it a little bit each month, you spread your risk, and hopefully you can invest, when the market has a pullback. Any questions on that or anything else?
Oh, Madam Chair.
Yes, Raul.
This is Raul Herrera. I just wanted to applaud Greystone Consulting for the hiring of a VSU grad, and would encourage them to continue working on that sort of commitment to the university. Thank you.
Thank you.
Thank you.
May I ask another question, Madam Chair?
Yes, Glenn.
Yeah, what is the makeup of your firm, diverse-wise, and do you have any money invested with minority-owned firms?
Okay, yeah. So Morgan Stanley, we have roughly, I guess, about 80,000 employees. So I'm not sure of the statistics of the, a breakdown on that, but I do know that we do utilize our global investment management group. They interview managers to be on our platform. Some of the questions they ask them revolve around diversity and inclusion. And we specifically do have a list of money managers that are minority-owned and or women-owned. So we do utilize those managers. They are on our platform to utilize.
Do you know how much is under management by those firms at all?
Yes, billions of dollars. Yes. I mean, these are firms such as Lazard, Ernest Partners, ClearBridge. These are well-established firms, and they have various strategies that are run by minority-owned teams. So, it literally is in the billions of dollars.
Okay, thank you very much. Okay. We'd like to know what that detail was on that. Thank you.
Well, with that, Chair.
Yes, Ron.
Just a final follow-up. If I could just follow up on Visitor Sessions' comment and ask that in the future, and I'm sure somebody, a chief diversity officer at Morgan Stanley knows this, but if our advisors can report back on the stats in regards to diversity in professional staff, as well as the use of diverse other investment advisors and companies. Thank you.
Okay. Thank you. We have that noted. I'll follow up with Kevin on that when we look forward to reporting as well. Any other questions or comments? If not, thank you so much. We appreciate your presentation. Kevin, you're back up.
Thank you.
Thank you.
Madam Chair, this is Greg
Yes.
Worley.
Yes, Greg.
Are all the money managers out of the room at this point?
No, they're leaving right now.
Okay. I would like to make a comment to the committee once our guests have left.
Okay, Elizabeth Worley, they've left.
Madam Chair, I think there's, if we could, even if the staff had to do it, kind of normalize some of the data between the two groups so that we can compare the performance. I particularly like the schedule that came from Morgan Stanley, where that they showed how much we started off with, they showed how much we contributed from inception to date, and they showed how much we've gained through the market. Coming down to our ending portfolio. Such a similar schedule was not available in the SPADR management item, at least I didn't see it. And I would like to try to figure out how we can put them on the same reporting schedule such that we are comparing the returns on the same period. And I recognize that SPADR could only give us through September 30th, and they were estimating through December, versus Morgan Stanley was kind of reporting on December, and we know we had some big spikes during that fourth quarter. So it's kind of what we talked about before at a last year's meeting, is somewhat normalizing that data so that we can really compare the performances between those two groups to see who's doing a better job. Thank you.
Thank you, Greg.
Madam Chair?
Yes.
Yeah, this is Jay. Greg, I think that's a great point. These kinds of firms like to come in and tell you how they're doing against their benchmarks. And we have two different firms that are using two completely different benchmarks for their comparisons. Makes it really, that makes it tough. You could look at the performance of one firm against the other firm, but that doesn't make but so much sense since they're aiming for different targets. And trying to find a way to compare one to the other under those circumstances is kind of difficult. It puts something back on us to decide, are we giving good direction in terms of the targets we want them to be aiming for? Obviously we got two different firms aiming at two different targets. Does that make sense for us? And then that comparison thing, we do this every year, relatively early on in the year. And Greg, I think you're right on target. When do we come back and look at the final numbers? I understand why Spider's numbers are late coming in. A lot of my investments, I don't have final numbers on December yet, and may not for another 30 or 45 days. But at some point in the year, you get those final numbers, and at that point, we ought to be going back and having another look at it, rather than just, what we did today, which was, okay, we think this is where we're going to be, and that would be the time to also have a more thorough look at the comparison between the two.
Madam Chair.
Yes, Mr. Rector.
Just a point of information to the committee. We are live streamed, so this is a public discussion.
Thank you for the reminder, Mr. Rector. Okay, Kevin?
Okay, I wanted to proceed on and give some updates to some materials before I get to the quarterly financial statements for December 31st. The first item is, you will see on your agenda, we had scheduled Mike Reinholz from Auditor of Public Accounts, APA, to come in and give an update. They're still wrapping up that 2019 audit. We've given them all the information that they need. They have assembled the report and sent us a sort of final copy of the management letter comments yesterday. And they're looking at trying to distribute the report sometime next week. Overall, we were going to have Mike, after we issued the comments, to kind of talk us through the management letter comments. But I can tell you overall, we're looking at about 8 comments. 3 of those comments are repeat, are considered partial repeat comments, meaning that we've made a lot of progress, but the auditors still feel like that they want to keep it open. If you recall, we got somewhat jammed up with the audit cycle. By the time we finished the 2019 audit, we were about 75% through 2020, so it was really tough. Then there are 2 that are just repeat comments we hadn't made any progress on. And then I think you know about the NIFA comment that we anticipate, and we anticipate a couple of comments relating to improving our documentation here on campus, particularly in the area of procurement and some of those things. So overall, that's kind of the strategy for the audit. You can expect that audit plan again to be released sometime. The financial statements, which are all of the numbers and disclosures, as well as the report on the internal controls. Are there any questions on that? All right.
Chair, this is Greg Worley.
Yes, Greg.
I think this is an important audit, and we talked about this for some time now. Is it possible that, and you don't have to answer now, but is it possible that we could hold a special finance committee meeting to review that audit report once it's once it's been issued next week, and have our auditors in to explain and go through the report.
I don't know if there is a need for it. Once we get the report, I guess we can make that determination once we actually have it in hand. I know we are in line to actually receive a copy of that final report, and I think we can make that determination once we get the report.
Yes, that's fine. I just realized that, you know, we have some issues that we have to get fixed by the summer because of the material weakness, a reported material weakness in the report. And this report has a great deal of bearing on our compliance with the share issues. So therefore, I would recommend that we look at this quickly to determine if there's a need for a special meeting. Thank you.
Thank you. Okay, Kevin?
Are there any other questions relative to the audit before I move on? Okay, the next item on the agenda, again, before we kind of get to the financial statements, is this Corona Response and Relief Supplemental Appropriations Act. This is in essence stimulus funds, the second round of stimulus funds. If you recall, we received that first round of stimulus funds, about $6.8 million. Had to distribute about 3.4 of it directly to the students in the form of emergency aid. We did that. The balance we used for reimbursing ourselves for the room and board refunds that we had to do last spring. And so we have a balance of about $1 million of those funds still left. These are new or considered the second round of those stimulus funds. This round is actually a little bit better than a previous round. Instead of getting 6.8, this time for the second round of funding, we're getting about 10.6. We're still going through the requirements, but it looks very similar to the first round of CARES money that we had from the stimulus package. So we're probably looking at for this, distributing that 3.4 directly to the students, similar to what we did with the previous amount, and the balance of that will be 7.2 million, and that 7.2 million would be able to use toward coronavirus expenses, as well as reimbursing ourselves for any lost revenues and other things as a result of the coronavirus. So overall, this pot of money is not included in any of the numbers I'm going to be going over today, but this is yet some additional resources that we've secured for the institution. Any questions about these new stimulus monies? Okay.
Just one quick question, Kevin. I'm sorry, on the last statement that you made on the second round of money, that you said 3.4 going directly to the students, and then the 7.2 can be used for Corona expenses and reimburse us for lost revenue. Is that restricted in the grant as it is given to us, or is that our discretion that we can reimburse ourselves? Just trying to be sure on how we can use the money.
No, that is, we're not imposing that restriction. We're looking at the restrictions that are being imposed by the federal government. So, and we're following those guidelines.
Okay,
so go ahead.
I'm sorry, you're correct. Go right ahead.
All right. Oh, and the guidelines just basically say that for that 7.2, they actually call it the institutional share. For the institutional share, they're looking for you to put it toward coronavirus type of expenses, you know, PPE, some of the things we're doing, online instruction that the provost is doing, but they also have broadened that out as well too, and will allow institutions to look at any lost revenues they have. And of course, we've had quite a bit of lost revenues in terms of room and board refunds, and particularly when you look on the auxiliary side. So we'll be looking to really shore the institution up using these funds to fully shore back up Virginia State.
Thank you.
Okay. Item 1 on the agenda is the only approval item that we have this time, and that's for tuition and fees. This is, I think in the past, we probably have brought this forth later in August. This is part of an effort to kind of set these fees a little bit earlier, and we feel like we're in a good position to actually make the recommendation. So the recommendation this year, and you will see in your package, there's a resolution that's on page 17, and their schedules, the schedules actually start on page 23. I was not going to go through all of those schedules because all of those schedules, you can peek at them, they basically say 0. And our recommendation here is for a 0% increase. We're in the same position that we normally are in. We know we have some potential increased costs next year, but we feel very comfortable that we can handle those increased costs, particularly with having more students enrolled than what we had budgeted for this year. Any questions about tuition and fees?
Madam Chair?
Yes.
This is Jay. Mr. Davenport, do you have any insight as to the direction that other universities around Virginia, including those that might be considered competitive with Virginia State, are doing, what their plans are around tuition for next year?
Yeah, I mean, what I've been hearing from my colleagues, and we've been talking about it quite a bit, some of the larger systems traditionally every year, they push for increases and they have expenses that they push for. I've seen a bit of a pullback from that group. They're looking to try to keep theirs stable too. I think they're just like us. I think coronavirus and COVID and dealing with that and the nature of that, I think they're trying to keep theirs to very minimal increases, and some of them have indicated as 0. So I've certainly seen that move, and I think Norfolk has always been in line with us, and some of the other ones like UVA-wise are really trying to keep those tuition and fees lower. So yes, I do see a movement, particularly from the larger ones.
Thank you, Jay. Thank you, Kevin. Any other questions? You may continue, Kevin.
Okay. One item that is not on the agenda, but I was asked to kind of give an update for, and that is on the student receivable standard. This is the management standard that we missed last year. We had to submit a corrective action plan to the state. They work with people over at the Department of Planning and Budget, and we're going to share what that corrective action plan would entail. In general, we put together a timeline of different steps that we need to meet in terms of making sure that we turn the accounts over to the collection agency, making sure that the write-off is done in a timely time and in a timely manner, making sure we follow up with active students. So we put the timeline together. The bursar is actually responsible for the timeline. SHEV and DPB have that timeline, and we're prepared to meet each one of those benchmarks. I'll tell you the key is shoring up some of our staff positions. I think you all know I've had some vacancies in the collections area. I have given the word to approve for a full-time position and a part-time position, and that certainly will help bring it up back to where it needs to be. The person responsible for actually hiring the positions, and she will also be training the new people when they come in, and we want to hire them at the same time so that the training can be done in a very efficient way. But the person responsible is Pat Raines, and I think Pat was just had a new appointment as the vice chair of the University Council. So Pat, she's already started with that process on getting the people hired. And of course, that's going to take a little time. So to fill that gap before we can bring the permanent people in, we're looking at temporary people. I've already contracted with the previous bursar. He was here like 20 years, has a lot of experience. He's already on contract. He's back. Had another employee that left. She retired. I actually brought her back as a temp as well too, and they are both filling in until we can make the positions permanent. Any questions with that?
Madam Chair, this is Greg Worley.
Yes.
Thank you for that update. Kevin, do you think we have to have these issues, I guess, resolved by this summer? I don't know the exact time. Do you believe that we will have these accounts receivable issues resolved by this summer?
Yeah, I think we will be back on track with resolving the issues and making sure we're doing timely write-ups and other things. And we would actually be looking at the standard. Now, we're not going to be in compliance in the summer because they have to look at an entire year. But as long as we do what we have to do according to that particular timeline, bringing us into the summer, when we end fiscal year 2021, so that December, our expectation is that we will be once again below that 10% threshold.
I guess I just wanted to make certain we were doing what we needed to do to get off that probation issue.
I think we are, yes.
Thank you.
Thank you.
Any other questions relative to that before I move on? I think the last piece that I have is just kind of wanted to quickly walk us through the quarterly budget to actual report and the actual to actual report. I'll start with the quarterly budget to actual, and that's actually on page 33 of diligence. All right, and I will I'll try to be brief and give an overall summary here. The top is, this is for the reporting period we do every quarter. So this is the reporting period ending December 31st, which basically represents 6 months of our financial performance. We have another 6 months to go, but this is our 6-month quarterly financial statement. The top part here, the E&G under revenue. Yeah, you can, hopefully you can see the cursor I have, but the E&G revenue, these are all of our state funds that we receive, and we break them up into university funds, state funds, and we have a separate category for carry forward and a separate category for the CARES funds that we receive through the state. That's different money than the federal stimulus money, but this is in addition to that actually flows to us through the state. Overall, I will say we look exceptional. You can see typically we're looking at the percentage of the budget for state funds. We want to receive about 100% because we get those funds up front. We want to receive them by this time frame. We're looking for that number to be 100%. As you can see, that numbers are whopping 142%, meaning we've exceeded it by 42. You can see the large places where we've exceeded it. This top line for the university, that's 6.9. That is, when we talked the last time, that is new money from the state from some selected programs. VCAN, the money that Mr. Hall talked about in his session yesterday is actually included in that, in this amount. If you recall, the last time we talked about these funds, they were unallotted, and now the monies have come back and we've actually received them. This is the amount of carry forward that we have, 55. The change in the carry forward, if you recall, by intention, we wanted to manage appropriately where most of the funds ended up on the auxiliary side that could add to our reserves. And then here are the additional monies from the state at 9.4. Again, that's more money for coronavirus type of relief. And when it initially came, the money had to be spent up by December the 31st of this year. And I think before the holidays, my staff, we were all scrambling. We were actually meeting every day, and it was quite a bit of effort, particularly on the procurement side. And then probably a week before December 31st, they come and say, well, we're going to extend it out and now give universities an additional year. So we went through all of the effort, and you will see as I kind of walk through here, we have a lot of those funds already committed because we work really hard before the end of the year. The non-general funds revenue, that's our tuition and fee revenues. At this point in time, you know, typically we want to see a good 52-53% there. We want to see it a little higher than 50% because for the spring semester, we always know historically there's a little bit of attrition. But for tuition and fees, you can see if you look at the total non-general fees, we're at 62%. Again, we typically want to be at the 52 to 53%. So that 62 looks extremely well. You can see it's being driven by this large number here for tuition. We actually recognize for that 6-month period, tuition revenue of about $17.8 million. And if you look at what we budgeted here for the fall tuition, you can see we're up a solid $2.7 million. So we're looking very good, looking extraordinary for the state funds, very good for the enrollment as well too. The other point I will make, and I think this is a unique position to be in, certainly the first time I've been in it. When you look at the total revenues, and again, we're only 6 months through the year, we have 75.2 total revenues, and we budgeted for the whole year 70.9. So we already have met our revenue goals for this year. On the auxiliary side, I will go through the auxiliaries a little bit more detail. But again, if you take that, this is the actual revenue from the auxiliary, 7.5. This is what we budgeted, 6.2. So you can see we're doing very well on the revenues from a budget perspective on the auxiliaries. Sponsored programs. Sponsored programs is an area we continue to see the spending being relatively slow, primarily due to COVID and people working, I guess, remotely and other things that are just not as efficient. So those numbers are slower. This is the revenue part of the sponsored programs. And of course, as you know, the revenue, we don't recognize the revenue until the money is actually spent. And then this next group of funds under revenue, particularly here, these are all of the various state categories, additional categories for CARES funds. That first one, CARES, Stimulus Funds, Institution, if you scroll over, that is that original round one of CARES money that I talked about that has already been used. This is the remaining balance on it, roughly 900,000. The MSI CARES fund money, again, we refer to it as the HBCU money, but that's for minorities serving institutions. We have about 9.8 that was actually budgeted for that. As you know, those amounts are approved. This category works very similar to sponsored programs. We don't recognize the revenue until those expenditures are actually identified. And then the last one is just the remaining piece that we have from the student share. I believe all of that may be gone right now. And directly under that, student financial assistance, you know, as you can expect, yeah, we got the 9.5 from the state and we received it. Directly under that is local funds for $825,000. I have an asterisk next to that, and we've all done quite a bit of talking about the $30 million. The $30 million, when it initially came into the institution, it had to be anonymous. In order for us to make it anonymous, I had to park it in a non-operating fund, and these pull all of our operating funds. That has to be removed. It didn't put it on this report because when we generate these reports, we list the numbers directly out of Banner. We do no manipulation of the data or anything like that. So that 30 million, by the time when McKinsey Scott actually made the announcement, I think it was like 2 or 3 days before we broke for the Christmas break. Those monies just really couldn't be moved to the appropriate category. So you will see on the March 31st statement, when we actually do that, you will see in this particular category of the revenue, you'll see that 30 million from the McKinsey Scott. Oh, sorry, is there a question?
Yes, Madam Chair, this is Greg Worley. I do have a question.
Okay.
Kevin, what is a non-operating fund? Could you explain that, please?
It's a fund that it doesn't go into what we're reporting here as our operating results. Like an example of a non-operating fund would be a person sending in money to their endowment fund. We would not capture that as revenue. They were actually adding it to their endowment principal. And it kind of comes back to when we even talk about gifts, and that question has come up historically about where all of the gifts at the institution. You know, the ones that are considered like operating gifts are those you will find in local funds. The endowment gifts, they're going to fall below the fund, below the operating numbers, and they would be considered like an addition. So funds like that, there's a number of funds that aren't considered operating funds, like capital funds.
So, Madam Chair, I would ask that maybe you would look at that non-operating fund and see if that is something that should be reported to this group in the future. I was unaware that we had revenue even flowing through another fund. Thank you.
Thank you.
All right, and on the expenditure side, and I will walk through, I always think it's better, I think when you look at the actual to actual, you'll really be able to get a better sense of what we've done on the expenditure side. But real quickly here, you can see the total expenditures for E&G, by bucket is about 56%. That's typically where we are. You know, again, ramping up the school, we see clearly more expenses the first 6 months than we do that second 6 months. And in fact, that last quarter, the expenses really go down quite a bit. So that 56% from the standpoint of a budget is about where we need to be. And again, I'll kind of go through the expenditures when we look at the actual, and you can see what we spent this year for auxiliaries compared to what we spent last year, and also for E&G. But I think where we need to be. Then below here are the auxiliary expenses. Again, I'll comb through those a little bit more. Here's a piece for sponsored programs. Again, we know it's a little bit slower spending there. This this category here is the actual category of spending. You can see we budgeted for the CARES stimulus funds, we budgeted, expenditures for CARES of about 9.9 million. You don't see anything going against that budget. Those expenditures are in this line item here. We had initially planned on using that we initially planned on using this 9 million above this MSI or some of these monies for those expenses. But when we got approval from the state funds, we actually use it for the state side and have classified it down here, CARES received from the state. And here's the financial assistance piece and the local funds, and again, a cooperative extension. Before I go to the auxiliaries, are there any other questions on the lead sheet here?
Madam Chair?
Yes, Chair.
Mr. Davenport, it's a great report, by the way. Thank you. As I look at this report for this particular period, I'm trying to get a sense on a moving forward basis, where would we be? And I know there's a lot of moving pieces here, one-time revenues, and one-time expenditure savings. So I can kind of piece it together, but not like you might be able to do. What do you see moving forward when you look at these numbers and you think, okay, I know this is going away next year, I know that's going away next year. It's great news today, but what do you see going forward? Are you optimistic about what you're seeing here, or do you have some concerns we ought to be thinking about? Any insight you could offer would be appreciated.
Yeah, that's a really great question and a difficult one to answer. I would say I'm fairly optimistic because if you recall back in the summer, we went through an exercise on both sides of the house, the instructional side as well as the administrative side, and it was a very difficult exercise for this institution to go through. I think that was really needed. That gave me a lot of comfort. As you had mentioned, when you look at these funds, I don't want people to be fooled. These are one-time monies. You know, when we looked at our expenditures, we really believe that those reoccurring expenditures need to be brought down and more in line. And we did that, and I think that exercise really made me feel a lot more comfortable. But these one-time monies, these are great. The McKinsey Scott money, of course, is great. It's putting us in a really good position to be able to manage it. And of course, if I had my way, I'd put everything in a dollar. You know, so we have a tremendous opportunity, I think, to really, you know, strengthen Virginia State just for future. I mean, none of us would be here, and we could really leave this institution in a much better condition. So I think we're there to do that, and I'm really proud of what we've done with our recurring costs.
Can I reframe Jay's question just a little bit, Kevin? Because I think I believe I hear what he's really trying to ask in terms of the one-time money, not talking about the McKinsey Scott money, but a lot of this one-time money, and this is the question, is restricted or must be used by a certain amount of time. Is any of this money free enough or unrestricted that would carry over into our operating to cover some of the things, you know, like new positions or things like that, or are all of them? Because in other words, what Jay is asking, okay, we know we're going to get our state money, you know, that offsets the tuition, and then we're looking at just a regular routine budget from that perspective. And of course, we're back to the same conversation about if enrollment continues to go up, we're okay. If not, we're in trouble again. So with this one-time money, are there any excess funds there that will be able to carry over into our operating to help us out? Or are we up against those deadlines to actually use it for the restrictions that were associated with it?
Well, I mean, of course, we're trying to be as flexible as we can with that money within the rules and regulations. So
okay.
We will be using those monies in that way. And so it's restricted, but we hope to use it in a way to help. Did that help? I'm not sure it did.
Kind of, sort of. I mean, I think we're still back to, as we're looking forward, obviously we're optimistic because we do see the increase in tuition and enrollment is higher than what we expected. So obviously we're going to have excess dollars coming just strictly off of that line, which enables us to be able to do some of the things that we're going to continue to talk about. And obviously the one-time money is definitely needed to offset all of those expenses that we knew we were going to incur because of COVID. So I think what I'm hearing you say, which I think addresses Jay's question, is all of those unanticipated expenses because of closure, i.e. revenue loss that you just shared, that some of the money can be used to offset and recoup that, as well as decrease in tuition because they're not on campus and things like that. A lot of this one-time money will be able to be used to offset that. Is that a correct statement?
Yes.
And so moving forward, Jay, we're back to when this one-time money is gone, looking very hard at tuition, enrollment, and then the associated costs with those things once kids are back on campus and things like that.
Oh, right. And I think that's, you know, I know it's not the purpose of this meeting, but I'm just trying to get myself mentally prepared for what we're going to be looking at when we start looking at the budget at the next meeting.
Correct. Correct. Any other questions? Okay, Mr. Davenport, you may continue.
Okay, I'll move on to the auxiliary schedule, which is the next page in your package. Set up the same way. Here's the fall and the spring budget, the adjusted budget on the auxiliary side. Not a lot new here. You can see from a budget perspective, we hadn't had, and again, this is through six months, had no room or board revenue. I will say on the comp fee here, again, this is what all full-time students pay. Our comp fee rate was the same this year as last year. You can see from comp fee, we've done pretty well. Again, we added that fall budget so you can kind of put it in a different perspective for you. You can see we had $5.4 million in comp fee revenue as compared to that 4.6 that we budgeted. So and that is strictly due to enrollment. The other categories, probably think I need to do this a lot. Yes, just make the point overall here from the budgetary perspective. Again, when you look at the different categories, student fees, actual 7.2, and we've only budgeted 6. Other revenues, small. We didn't bring in a lot of other revenues, obviously, with the campus being closed, but we did exceed what we had budgeted. On the expenditure side, you can clearly see we budgeted $9 million on the auxiliary side, but only expended 7.4. So again, that's right where we want to be. Generally, our expenditures, you know, being less than the budget, and our revenues exceeding it on the auxiliary side. I think probably one of the most important things on this schedule would be the next page here. Service number. If you recall, I think at the last meeting, I presented working with the state debt refinancing, and in your is some slides on that as well too. We're looking at a potential overall savings for the debt over the next 2 years of roughly about $3.5 million per year. You're not seeing any of that savings in these numbers. Typically, that principal payment is due in April-May timeframe, so you probably won't really see that savings until that last quarter. But we do expect about a $3.5 million savings on this debt service piece. Other than that, are there any other questions on the auxiliaries before I move on? Okay. And the next sheet is Schedule 2. This is our College of Ag financial performance. The top part of the revenues here, these are state funds, and then this is the non-general funds, their federal piece. You can see on the state side, they've done incredibly well. This $1.4 million of additional money, those are the unallotted money that we talked about before. They've now been approved, and the College of Ag has received that 1.4. In addition to that, they had carry forward funds of about 1.6. So total general funds, they are over about 3.1. Excuse me. Similar to the university, you can see, you know, typically we want to get 100% of the revenues. They have 155%, just a very good position to be in. This category here, again, this is the federal piece. It works similar to sponsor programs. When we expend the funds, then they can draw down those funds to capture the revenue. didn't see,
Got it. I missed it.
they probably have about another 5.9 million, you know, to hopefully spend as a part of their federal budget. And so if you look at the 5.9 plus the 3.1, they have a good close to $9 million in funds to spend.
Okay, I got to remind everybody to please mute yourself if you're not speaking. Please mute yourself.
Any questions on 234 or the College of Ag before I move on? Okay. Next, turn your attention to the actual to actual report. That's on page 38. Again, the same type of things, but I'll quickly walk them through. Here, this is the current year, 2021, and this is the prior year, and this column here is the change, and this column is the percentage change. You can see we have $6.9 million more on the university funds because of the unallotted piece. That, again, is just a change. This is the additional CARES funds of 9.4. So again, I'm comparing actual results now to where they were last year. So where we stand now, as compared to last year, on the state side, we've received nearly $16 million more. On the non-general side, making that same comparison where we are today as compared to where we were last year, you can see we're doing not as bad as we thought we were going to be. And what I mean by that, we thought this number would be down about 20%. We were looking at a 20% enrollment reduction, when in fact we did a lot better than that, which is a very positive thing because it says our product is fairly strong and could resist that. But that 5% is mainly due to the enrollment decrease. If you factor that into the additional state monies, you can see overall, from a revenue standpoint, again, we're $15 million better this year from a revenue perspective than we were last year. So it's very good. On the auxiliary, that's where we needed it, you know, with having the campus closed for the fall semester, the $18 million, the lost revenue. And then here's the slower sponsor programs. You can see this year we only have drawn down on the revenue side 12.9, whereas the same time last year was 15.1. And again, that's directly because of the pandemic. Then I'll go through the cooperative extension here. Expenditures, again, I think it's looking at the actuals better. This is exactly where we want to be, you know, have a lot more revenue, and you can clearly see these are just the E&G expenditures. You can see we were at 40.3 last year, now we're at 36.5. Some of those reductions that we did during the summer, you're beginning to see that pick up. If you recall, last quarter, we didn't see as much savings. Auxiliary, when I get to the expenditure side over there, we'll go through those savings. And again, I think the balance here is just things we talked about before, the COVID expenses and the local funds. If you go to the next page would be the actual performance for the auxiliaries. You can see, as you would expect, revenues will be down tremendously because campus was not open. All of the categories being driven mostly by residence life and food service. On the expenditure side, I was happy to see this because we have the expenditure savings on the E&G side, and this is on the auxiliary side. You know, we tried to reduce there as well too. And you can see that last year we spent, you know, $15.5 million. This year, 7.4 million. So, you know, we're under those savings by whopping $8 million. And, you know, quite honestly, it was a slightly better than I thought we would be. And that's it from the standpoint of the financials. And again, are there any questions on the actual? Okay, Madam Chair, the only other thing that I had in the report is, in the package, is an annual debt report. I was not going to go through that debt report. That's a standard report that we have to bring before the committee every year. It just basically shows where that debt is. Most of it is on our residents' life facilities. I believe there is a slide in there about the refunding. Again, I wasn't going to go through it. We're not proposing any additions to our debt at this moment, and we're in compliance with our ratio.
Thank you, Kevin. Are there any questions on the debt?
Yeah, Madam Chair, this is Jay.
Yes. Yes.
Kevin, I just want to, I think that I heard you correctly on this, looking at your slide on page 48 of the debt savings. Again, those are one-time savings over the 21 and 22 fiscal years, if I'm reading that chart right. But you, in the slides we just went through on year-to-date performance, you have not taken account of those savings at this point in time.
Yeah, correct, because those savings, that principal payment that is due in May, we anticipate that principal, we're not going to have that principal payment. The savings will be realized in that last quarter. And it should be roughly about 3.5 million savings each year. And then, of course, after that 2-year period, it will return back up to our normal debt service payments.
Right, that's what I thought I heard. And going back, Madam Chair, to your question, it looks to me like if we end the year well, those debt service savings are funds, and Kevin, correct me if I'm wrong on this, but that's funds that we could set aside to help us manage through whatever's facing us in those out years.
Absolutely. That's my understanding. Kevin, is that yours? Is that correct?
Yes.
Because those are pure actual dollar savings, Jay.
Yeah, I like that. Of course I would like that, but thank you.
Yes.
Great idea. Any other questions?
I think we are good. Thank you, Mr. Davenport. I appreciate it.
I don't know if we need a vote on tuition either.
Yes, I believe we do. I think we need a motion to approve recommending that resolution to present it to the full board for approval. That's the resolution authorizing a no increase in the tuition and the fees that was presented at the top part of Mr. Davenport's presentation. So if there are no questions on that resolution, I will entertain a motion to approve the recommendation of that resolution during our full board meeting.
Madam Chair, this is Jay. I'll make that motion.
Madam Chair, this is Bill Murray. I'll second.
Okay, we have a first and a second to approve making the recommendation of the resolution to our full board for approval. Can I have a voice call vote? All in approve, say aye.
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 Any opposed? Dr. Red, may we have a roll call?
Yes, ma'am. Dr. Valerie Brown,
Yes.
Mr. Fleming, Mr. Raul Herrera,
Yes.
Mr. Charlie Hill, and we're still having technical difficulties. Mr. William Murray,
Yes.
Mr. Jay Stegmeyer,
Yes.
Mr. Wayne Train, Mr. Gregory Worley,
Yes.
thank you.
Thank you, Dr. Red. We're now ready for Ms. Alves and our internal audit report.
Hello, everyone. We can go ahead and advance the next slide. So we're pretty much, it's going to be a short discussion today from an internal audit perspective. We have the corrective action plan status, case workload, the audit plan status, staffing plan, and Commonwealth update, and our consulting services. So we'll start off with the corrective action plan. We have 43 items that will show up on the detail, one of which was closed since the last meeting. And I want to thank Dr. Palm, because that particular one was in memo form last time and has quickly been closed. And so what we have left is 42 that are open. And then this just gives a depiction of where the risk lies with those items that are still open. And then this gives the category as to their aging. So as you can see, we have one on the far end that's at 2.5 years, and then on the low end, less than 6 months. The one that we need to watch for if we're looking for decrease or getting closer to level 2 is the second item, that blue item that says PC. So once that starts reducing, then we can feel like we're getting closer to reaching level 2. Next slide, please. And so this is our workload. We have 12 cases total, 0 hotline cases. I'm gonna say that one more time, 0 hotline cases that are left, and we have 12 remaining. So we're really excited about the fact that, and I'm knocking on wood, because as we speak, we have no hotlines in the pipeline. Next, please. And then this just gives us the outlook, historical view of the hotline versus our investigations. Okay, and then as I stated before, we have 0 hotlines. 3 cases were closed since the last time we met. And we were trying to get to 0 since some things have changed, which I mentioned previously, that from going forward as of February 1st, any hotlines that extend past the 60-day, I think they give you a threshold of 120 since you received it. If you do not say you need extra time, and if it's not granted by OSIG, then that would be reported to the Secretary of Education in our instance. So right now we're not in jeopardy of that. And then so as you can see, the breakdown of items that have been completed and their status. So if we're looking at 2020, we have 4 that were actually substantiated, and then we have 2 that were unsubstantiated, and then we have 1 that was inconclusive. And what that one means is we didn't have enough information to determine if it was substantiated or unsubstantiated. Okay, and then so this is the slide that just gives a breakdown of the cases. The fact that they're open doesn't mean we haven't started them, because we have some of them, but it's just not to the point of closing them. And then this gives the breakdown from an investigation status of what has been substantiated, either screened out, and that means we received it from OSIG, but, or excuse me, from, in this case, it's special investigations. We looked at them, and because there wasn't a case there, we kind of investigated, and then from that it's screened out. But most of the time, we don't anticipate. I think that's just one item that was actually screened out. And I think it was screened out because the subject of it had left the university. And then we refer a few. So in the event that it's potentially is a criminal case, we don't handle those. So then we refer them. Next. And criminal meaning theft or something like that, nothing major. Then the workload status. So in the packet, there is an item that we did investigate. It was based on a hotline, but we were actually in and we noticed a reconciliation concern. So what we get are commissions from one of our major vendors at the university, and that breakdown isn't broken down in a way that we can tell specifically if we're getting the commissions based on each event. It's a lump sum that's submitted. And so we're recommending to management that in order for them to be able to look at things from a business perspective to tell if they're getting everything they expected to receive or if they need to make some adjustments with how they're handling events, this should help them do that. So that one was the one that was completed. And then the university clearance is in progress. We're in the reporting phase of it. And then enrollment is a new one that we've started. And we'll have the entrance conference, I believe, next week or before the month is over. And then the next slide. And so the great news that we have currently is that we were able to hire the position or get the resource back for the position that we were in the process of hiring. But then when COVID hit, we had to cease all hires. So we actually requested that from the president and Kevin, and we were granted that. So we should be able to start hiring for the position that we had to hold off on. Next item. Okay, and then this is just to give you an update of where we stand. I've already mentioned the update from the State Inspector General as far as making sure that we're compliant with the timing of our hotlines, and so far so good. And this is just to let you know that February 1st, if we don't get them done within the time frame or an approval from them to proceed, then we're subject to be on a report that goes to the Secretary of Education and then to the governor. And then I have my normal meeting coming up with the college and university auditors, which I'm scheduling as we speak. And I believe we can go to the next slide. Okay, and this is just a continuation of the things that we are working on from a consulting perspective, processes in the bursar's office, finance and procurement, and accounts receivable. So with that said, does anyone have any questions or concerns?
Ms. Alves, what level position is that you're filling?
It's a senior auditor position.
Okay. All right. Thank you.
So we're hoping to have someone that actually has experience, because due to our size, we don't really have the time to spend on the training end of things.
Okay. Right. Are there any other questions? If not, thank you, Ms. Alves.
Thank you.
Okay, unless there are any other questions, we have come to the end of the agenda for the Facilities, Finance, and Audit Committee. And hearing no questions, no hands raised, I will entertain a motion to adjourn.
Spill Murray, so moved.
And a second?
This is Jay, second.
Okay, we got a motion to adjourn this committee meeting. All vote, all in favor, say yay.
Yes.
Yeah.
Any opposed, nays? I don't believe we need a roll call for that, Dr. Red. No roll call, or we adjourn?
That is correct. No roll call. Thank you.
Thank you.
Madam Chair,
Yes.
do we just stay on this line for the next board meeting?
Dr. Red?
Yes, you may stay on this line, but we are taking a lunch break, and we will resume at 12:30. Director calls full board meeting. Director, is that correct?
That is correct. Being at 12.
Thank you, everyone. It's a great committee meeting. Thank you.
Thank you, Madam Chair.